What's up everybody, Gen X Dividend Investor here. In this video I'm going to review a dividend portfolio that was sent to me asking for my feedback, so I'll tell you my thoughts about each of their stocks as well as their portfolio as a whole, and then we'll end things with an overall rating. I recommend you watch this video in entirety, as you'll learn some helpful investing lessons based on what this person did over the years. And note, I'm not a professional wealth manager, so don't take anything I say as financial advice. I'm just sharing my thoughts based on my understanding of the stocks in question, as well as what I believe to be true about the person, their goals, risk tolerances, timeframes, etc. However, there is no objectively good or bad portfolio, so at the end of the day it doesn't really matter if I like or dislike something, it just matters what you think. I plan to run a poll in the community tab of my YouTube channel so that you can vote on this portfolio. That way we can see how everyone feels about it, not just me. In the last subscriber portfolio review I did a few months ago, I gave it a thumbs up and 64% of the people who voted agreed with me. 5% of you gave it a thumbs down and everyone else was in between. If you'd like me to review your portfolio in a future video like this, then follow me on Instagram at Gen X Dividend Investor and DM me anything you want to share about your portfolio and yourself, like the reasons for your investments, how old you are, your goals, career, retiring timeline, investing experiences, etc. I have a bunch of people who've already submitted portfolios for me to review, and when I do these videos I don't pick them based on the order in which they were submitted, but instead based on who shares the most info about themselves and their investing, along with what I think would be interesting and valuable to watch. Okay, today's portfolio came to me from a guy who runs a YouTube channel called Fishing with Big D. Feel free to use the timestamp on screen to jump to where I'm showing you his portfolios, but I recommend you keep listening for the info I'm going to share about him. I'll put a link to his channel in the description of my video, so follow him if you like fishing. A couple days ago he posted a mystery tackle unboxing video, and before that he posted a fishing in Virginia video. Here's a quick clip to give you a flavor of his stuff.
That's a nice rainbow. It's pretty.
Cool, I've never gotten into fishing, but I could see how it would be fun. Anyway, Big D is 38 years old and has been working at Gatorade for the last 15 years as part of their maintenance team. He's married and his wife is a pharmacy technician. They have a teenage daughter who is wonderful and probably makes it tougher for them to save and invest more, but they're still managing to invest. Big D said he has 3 brokerage accounts. Number 1 is a taxable account of Robinhood worth about 26 grand, which I'll be reviewing. Number 2 is a traditional IRA at Fidelity worth 45 grand. And number 3 is a work 401k worth 100 grand. So they have about 170 grand in stocks, which is awesome, especially for people in their 30s. He opened his Robinhood account about 5 years ago after watching YouTubers talk about investing, and he liked how Robinhood looked and worked. This is the first spreadsheet he made, back in 2019, listing all his tickers at the time sorted from largest to smallest market value based on today's prices. Note, I'll be doing my overall rating based on his 2023 portfolio, but I thought it'd be useful for you to quickly see what he bought and sold for each year he's been in the market. In his spreadsheet he lists the company, its ticker, the number of shares he got, the cost basis per share, and the total investment aka total cost basis. Then he lists the dividend payouts he got from month 1 aka January through month 12. Then he has a column for total dividend payments received throughout the year, and finally I added a column called market value so that you could see what each of his tickers was worth today relative to how much he invested in them. So in 2019 he started with 6 tickers and invested $5,280, which if he still held those same tickers today would have been worth about $6,200. His first ticker was a Fidelity Consumer Staples ETF, ticker FSTA, which he invested about $2,200 into. FSTA paid him $10.03 in dividends in March, and then $10.49 in June, etc., adding up to a total annual dividend payout of $47.40, and today his $2,200 investment would have been worth $2,950. Next up he had a grand in Fidelity's High Dividend ETF, FDVV. Then he had a couple single stocks in Pepsi and Nokia. Then he had $88 in Fidelity's Energy ETF, ticker FENY. And finally he put about $100 in Fidelity's International Dividend ETF, ticker FIDI, which I didn't even know existed. If we add up all the dividends he got that year, it came to about $132, which means about $11 per month. Small, but you gotta start somewhere. Okay, then we moved to 2020, where he said he started getting more serious about investing and he had more investable cash due to his work going well. That year he invested another 13 or 14 grand and added a couple dozen new tickers, as well as sold some tickers in red, and over the course of 2020 he made about $400 in dividends, which means he was averaging about $33 per month in divvies. I won't go over each of his new positions in this year, as I'll do that for his 2023 portfolio, but you can see that he bought some classic dividend stocks like McDonald's, Chevron, Johnson & Johnson, etc. He also invested in some higher yield things like Global X Alternative Income ETF and Starwood Property Trust, amongst others. I'd generally recommend against most high yield investments at his young age of 38 unless he needed the passive dividend income. You gotta be careful not to chase dividends for dividends' sake, and instead focus on what you think will yield the best total returns over the long run, where total returns are stock appreciation plus dividends. I found that higher yield stuff often ends up having lower total returns. Like I have some high yield tobacco stocks, but I limit them to about 10% of my overall portfolio due to their risks and due to the probable lack of stock appreciation. And it's important to realize that I'm already retired, and dividends mean especially a lot to me due to my health realities and my family situation. Okay, Big D told me that Dave Ramsey was a big inspiration to him, though he didn't always follow all his advice. Like Mr. Ramsey says that food is a budget category that a lot of people tend to overspend on. That means it's one of the hardest to forecast, and it's also one of your biggest opportunities to free up some extra money. Mr. Ramsey suggests skipping restaurants and cooking at home. He says pack your lunch when you go to school or work and make coffee at home as well. He realizes that small changes cutting back is effectively like getting a raise. But Big D said that he likes good food like steak too much, so he doesn't listen to that part of what Mr. Ramsey preaches. I personally think it's fine to splurge occasionally on food or whatever, as long as you're saving and investing and not taking on debt. Big D said that as the pandemic was taking hold, it became an emotional roller coaster for him and it caused him to get scared and he ended up selling some of his stocks. He decided it made sense to wait and see how the world recovered before putting more money in. Now, my general advice is to try to avoid selling stocks and just ride through the tough times, but I know that can be hard to do even for seasoned investors. That doesn't mean you should never sell, and you can watch my video I did on when I'd sell a stock. I've unfortunately seen way too many people freak out and sell, and then they stay out of the market because knowing when to get back in is tough. I mean, look at what happened in the markets around the pandemic. On February 14th of 2020, the S&P 500 was at 3380. Then the next month it fell 32% down to 2304. But look how fast it recovered. My point is that it's really hard to correctly guess what the market's going to do, so try to just buy good companies when they're cheap and then keep holding them for the long run. Okay, let's see what Big D did in 2021. He came into this year thinking he would invest more again, but then the January 6th mob storming the Capitol freaked him out and he sold out of his entire portfolio. Then later that year he got back into the market, and at its peak his portfolio was worth $27,000 and he made $794 in dividends. For references, Pepsi cost basis per share was at $140 before he sold out, and then he got back in and it was around $175 a share. Another thing he did that year, which I'd caution people against, was that he got into doing some stock trading rather than stock investing. Specifically, he got into the AMC and GameStop craze, though fortunately he made about $2,000 in profit. Maybe I should say unfortunately, because I think it would have been a better lesson for him if he'd lost money gambling on those risky stocks. The takeaway is that I strongly recommend sticking with long-term investing rather than short-term trading because the majority of people lose when doing anything short-term in the markets. I prescribe to the Buffett School of Investing, where you buy stuff with the intent to hold it for a long time. And speaking of Buffett, some good advice that his partner Charlie Munger once said was to watch out for liquor, ladies, and leverage, as they are 3 quick ways to go broke. And don't leave me a comment telling me how misogynistic that was. Anyway, Big D also mentioned that he had some non-dividend stocks he sold out of because he wanted to focus on dividends. Now, you can be successful being only in quality dividend stocks, but at 38 years old, I'd recommend also investing in quality non-dividend stocks unless he really needed that passive dividend income. What I mean is that I'd also invest in companies like Amazon and Tesla and Google and Berkshire and such, even though they don't pay a dividend, because I think their long-term total returns will be good. And of course, it's usually better for most people to simply go with VTI or VU and not even mess with individual stocks, at least over the long run. Whatever you do, just keep trying to grow your asset base. Wealthy mindsets try to acquire assets versus poor mindsets which tend to acquire things that depreciate. I'd rather you buy $70 shoes instead of $170 shoes and then save and or invest that $100 you didn't spend. Okay, let's move on to 2022 now. Big D had a rough 2022 physically because he broke his ankle while doing his favorite hobby, which is trout fishing. He ended up needing to sell some of the stocks he had rebought in order to pay off his medical bills. Of course, the ideal thing is probably to build an emergency fund so that you can avoid selling, but at least he had some good assets he could easily sell in an emergency situation. That year he ended with a portfolio worth almost $22,000, and he made $973 in dividends, but his cost basis was now over $24,000. But that's okay. You need a long-term mindset so you don't freak out if your portfolio goes down for a while. Moving on to 2023, and Big D was in his 5th year of investing. He said that inflation was bad, so he invested less than he otherwise would have, but he still kept trying to invest at least a little something into his portfolio each month. At this point, he said he was really noticing how compounding was helping things grow. Now he had 41 tickers, and I'll go through them 10 at a time. First is ALTI, the Global X Income Closed-End Fund, which has MLPs in infrastructure, real estate, preferred, emerging market bonds, and covered calls. I found that tickers like ALTI often perform poorly over time. Like, I'm used to seeing their stock price and dividend payouts trend down, and sure enough, that's what happened to ALTI. Next, he has McDonald's, then Johnson & Johnson, and Pepsi, all of which I have and all of which I consider solid. Then he has AT&T, which has been sputtering along, still laden with too much debt. Then he has Coke and Realty Income, both solid dividend companies. Then he has another Global X fund in QYLD, and it performed like ALTI, where it slowly went south. Then he has a solid dividend ETF in Vanguard's VUIM, and then another I own in Duke. Moving on to his next 10, he has New Residential Investment, which is a mortgage rate, and I tend to avoid those. Then he holds Digital World Acquisition, which is a blank check company kind of tied to political sentiment, particularly around Trump's potential 2024 comeback. It's a non-dividend stock, and unfortunately it looks like it dropped a lot. Next is a solid company I used to own and still like in Clorox. Then he has SPHD, which is Invesco's S&P 500 High Div Low Volatility ETF. It has a high yield, but I'm not a fan of how it prioritizes high yield stocks. Then he has Starwood Property Trust STWD, another mortgage REIT. Then he has NUSI, which is an income ETF with some market crash protection to it, but it doesn't really have downside protection, and I'm not a fan overall. Next he has Noble, which is a Dividend Aristocrats ETF, and then he has another utility I'm long in, which is Southern Company. Then he holds another Vanguard Dividend ETF in VIG, and then he has Procter & Gamble, a solid dividend stock I'm long in. Then he has Kraft Foods, which doesn't have the dividend growth I'd like to see. Then WBA, which unfortunately recently cut their dividend. Then he has a classic dividend stock in Colgate-Palmolive, which I'm long in. Then York Water, a utility that has increased their dividend for 27 consecutive years. Then he has Div and SDiv by the same company that does QYLD, and I'd expect a similar underperformance out of them. Next he has Chevron, an energy stock I'm long in, and then he has VTI. After that he has Bank of America and General Mills, both solid companies. Okay, then we come to his final page of tickers. Here he has Ares Commercial Real Estate, another MREIT, which has trended down in terms of stock price, and I wouldn't be surprised if they had a dividend cut coming. Then he has a Vanguard Total Bond Market ETF, which most experts would say is good to hold as part of your portfolio, though I'm not a fan of bonds myself. Then he has Ford and Dollar General, both reasonable companies. Then he has another Global X fund in RYLD, and then he has Stanley Black & Decker. Stanley's taken a beating but is trying to turn things around. They do have some great products, but they gotta get their financials back on a better trajectory. Next he has Warner Brothers, probably as part of that AT&T deal, and he sold out of that. And then he has Kimberly-Clark, which is a stock I'm long in, but it's one of my weaker ones. Then he has Ball Corporation, which is a materials packaging company, so think of aluminum beverage cans and aerosol containers and such. I'd never heard about them, so it was interesting briefly researching what they do. Looks like they've taken on a bit of debt and they need to improve their cash flow. Last year they announced plans to offload their aerospace segment, so hopefully that will put them on a better path. After Ball is McCormick, a Dividend Aristocrat that's a packaged food and spices company. Its stock has fallen a good amount from where it was, but I still feel it's overpriced given its weak financials and outlook. I guess inflation has been especially tough on McCormick. Finally, he has Orion Office REIT, which he probably got from the Realty Income spinoff, though office spaces in general have tanked. That year he managed to push his investable dollars up to 29 grand, though his portfolio is worth 26 grand at this time, but is yielding $1,172 in dividends per year. Big D also created this dividend growth chart showing how his dividend income trended up year over year. So it shows how many dividends he got in January for 2019, 2020, 2021, 2022, and 2023. Then he did the same for February, March, etc. Big D said he was proud to be investing and learning. He said his goal for 2024 was to improve his stock selection and sell some positions that aren't great. Another suggestion I have for Big D would be to include what sectors his tickers are in, so he can have a better understanding of where he might be light or heavy, at least relative to the overall market sector concentration. Okay, and what sort of rating would I give his 2023 portfolio? I decided I'd simplify things to either thumbs up or thumbs down, and while I like about half of his positions, I figure that's not enough to merit a thumbs up, so I'm giving it a thumbs down. Now that doesn't mean it's bad or that he shouldn't stick with what he has, it just means that I'm not fond of it overall. However, I do think it's awesome that he's been investing and has grown his asset pile to where it is today, so congrats. I'll leave a poll in the community tab of my YouTube channel where you guys can vote on what you think. And remember, if you'd like me to review your portfolio in a future video like this, then follow me on Instagram at GenXDividendInvestor and DM me anything you want to share about your portfolio and yourself, like the reasons for your investments, how old you are, your goals, career, retiring timeline, investing experiences, etc. And now I'd normally do a shout out of my latest Patreon aristocrats and kings, but I'm still all sold out. So instead I'd like to thank Seeking Alpha who sponsors me. I paid for their premium membership for years because I valued their articles and associated comments so much, and these days I'd literally never buy or sell a stock without first reviewing what Seeking Alpha had on it. So I recommend you sign up to them using my affiliate link in the description of this video, as using it often comes with benefits for new member signups. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. And I highly recommend that you join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 80 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.